Welcome to the December session of our ongoing webinar series. Today is on AI and market trends. As always, my name is Tom Bittinger. I'm with the marketing team here at Wealth Enhancement. And before we get started, I want to go over a few quick housekeeping items. This session will be recorded, so if you need to step out for any reason, if you missed something, you will have the opportunity to revisit anything that you missed. We'll be sending the replay to you at a later date. Hopefully no later than tomorrow, but it should be within the next couple days. And we will also be taking questions at the end of this session. So feel free to submit questions using the questions pane on your GoToWebinar menu. We got a lot to get into. So joining us today are Gary Quinzel and Aya Yoshioka on our portfolio consulting team. We got kind of a cross-country team going here. One's from New Jersey, one's from California. Again, we got a lot to get into, so Gary and Aya, I'll let you guys take it away.
Thank you, Tom. Hello, everyone. Thanks for having me today. There's been a lot of excitement, some confusion, and frankly, some anxiety all around artificial intelligence. And our goal today is to unpack what is really happening. So as the agenda will demonstrate, we're going to talk a little bit today about what's been driving markets. We're going to be talking about how AI is showing up in the real economy, including where spending is happening and how it all feeds into economic growth. We'll also be talking about how companies are adapting to the new technology, and especially the impacts around the labor market, corporate leadership, and investment strategy. And finally, we're going to kind of wrap it all up and talk about what that all means for your portfolio and as you position your investments as we move towards 2026. And it's important to note that we're not here to sell you on AI or dismiss it as hype. We're here to put this all into context, the context of a disciplined investment portfolio, so you have better information to guide you as you think this through. And just note that this is all evolving very, very quickly, and we're all adapting in real time. And so with that, why don't we jump to the next slide? We're going to talk a little bit about what's happening in the markets today. And so some of the key takeaways or observations here, as the slide says, markets in motion. What we're really talking about is how AI and equity valuations and financial conditions are all interacting. And what we've known is that over the past two or so years, AI-related stocks have been a major driver of stock market returns. But it's also contributed to a number of growing concerns about whether or not we are in some sort of bubble-like scenario similar to previous bubbles such as the dot-com. We note that we've had very strong price performance in AI-linked stock names. We've seen rising valuations that are based on the assumption of very strong growth projections for many, many years into the future. And of course, we've noted a significant increase in the capital that's being raised and being deployed into infrastructure. And it's, as the slide notes, it's not just that capital is being raised, but it's where it's coming from. We're now starting to see that shift into more debt raising, as opposed to in the beginning, in the early days, it was fueled by cash on the balance sheets. So that combination of high expectations coupled with all this aggressive spending is exactly why the AI debate, bubble debate, has picked up. Now, it's really challenging to call a top or a bottom. In fact, it's near impossible. So what we're trying to do here is just recognize that we are in a very powerful innovation cycle, and we want to be very honest about where the risks are building, so our portfolios are not overexposed if and when sentiment does shift. It's important to note also which sectors have benefited the most and how and where sectors might be a little more exposed. For example, software and platform companies, those sectors, expectations, as noted, are sky high. Investors are willing to pay up for profits that may be many, many years away, which makes those names much more vulnerable to letdowns in earnings. On the flip side, more traditional sectors such as industrials, utilities, and even real estate that's tied to data centers are being pulled into this AI story through higher demand. But of course, they also face very high financing and, probably more important, execution risk. So if we jump one more slide, I'm going to talk a little bit more about how specifically AI has propelled markets higher. And so we have two different line charts here. Naked eye, it probably doesn't look that different, but the numbers are quite stark. So this goes back to November 1st of 2022, essentially when ChatGPT was first introduced. The S&P 500 index has risen around 85% over that time, which is not too shabby. But if you take a look at the other line, which is the Bloomberg Artificial Intelligence Aggregate Index, it's gone up more than double that, over 207%. So what does this tell us? It tells us that AI has been a real performance engine, not just a headline. And any investor who owns the specific names have definitely been rewarded. Second, we note that leadership has notably become very concentrated, something we've talked a lot about in previous webinars. A relatively small group of companies, notably the Mag 7, companies like NVIDIA, et cetera, have been carrying a big share of index returns. Lastly, the gap between AI and the rest of the market is now wide enough that it raises the question, how much of this future is already priced in? And for investors, this is challenging. It cuts both ways because you want enough exposure to participate in the market if this trend continues, but at the same time, you don't want to be overly dependent on a handful of names for your long-term success. That's why we focus so much of our efforts on diversification and not letting one theme dominate our portfolio. If we flip to the next slide, we want to talk a little bit about the top 4 US hyperscalers. And the hyperscalers, by that I mean the 4 largest spenders in data centers. And those, of course, are Amazon, Microsoft, Google, and Meta, all large cloud and platform companies. Their data center CapEx has exploded as a race to build the infrastructure needed for AI, which includes specialized chips, massive compute clusters, as well as storage, networking, and power. So a few key points. This is where the AI story becomes real. These are billions of dollars of physical and cloud infrastructure spending. Recent research from Bank of America now sees global hyperscaler spending rising 67% in 2025, this year, and another 31% in 2026, with total outlays climbing to $611 billion. And while it does look like on a year-over-year basis, the percent of increase is slowing down going forward, these are still massive numbers overall, which is financed through a mix of cash flows as well as debt in some cases. So it's healthy, but it also means more leverage on corporate balance sheets. So if AI demand meets or exceeds expectations, this CapEx can drive multi-year growth across semis, equipment, utilities, and real estate. But if it falls short, some of the spending could look very aggressive in hindsight. And that is some of the biggest question marks we have to face right now. And so for investors, it highlights both where the long-term opportunities are and also where the risks lie if those expectations don't fully materialize. If we jump to the next slide, I'm going to hand this one over to Aya to jump in and talk a little bit more about data center construction.
Thanks, Gary. Really appreciate it. So as Gary mentioned, there's been so much money flowing into data centers, and it's really the infrastructure that is underlying the artificial intelligence revolution here. And so this chart really shows how much planned capacity is now underway. And you can see that sort of hockey stick, especially that light gray area in terms of planned data centers that are now expected to be built out over the next several years. And these just don't pop up overnight, right? It takes several years in order to get permitting, and that's why you see a dark gray area. That's the stalled data center growth. And so, it does take a lot of time to construct these data centers. It takes a lot of equipment. And again, there's just, the major trend being that not only artificial intelligence in terms of why we need to have more data centers, but just the overall need for compute and digitization that really impacts our daily lives, really, addresses why there's been so much growth on the data center side. So the compute intensity, especially for AI, really continues to grow, because now we're not just talking about large language models in which you have a chat bot and you can get nice, emails written up for you. But we are now seeing sort of models that incorporate visuals and video. And so a lot of that takes even more compute capacity. So, if it's just language, there's a certain amount of compute that's needed. For visuals, it goes another exponent higher, and then even more when it goes to video. And so this really explains why there's so much demand. And despite all the money that's already been thrown out and announced, companies such as Microsoft and Alphabet, the parent of Google, have stated that they expect the compute capacity to remain in shortage in 2026. And so again, there's been this rush to get these data centers built. And what Gary had mentioned is there's been this real shift from how these data centers have been financed. And so if you go to the next slide, this really shows the sort of circularity of financing and the concerns around the build out of AI. And so it's this great graphic that looks very complicated, but I think everybody's really concerned that there's just a few number of players that are benefiting from AI. And really, NVIDIA has been at the center of all of this, and you see that's why it's right in the middle. But also the sort of logo to the bottom left, that is the OpenAI logo. That is the parent of ChatGPT. And so, NVIDIA has been such a beneficiary for the AI build out that it will generate over $100 billion in free cash flow just this year in 2025. Their cash balance went from 13 billion on hand in 2023 all the way up to 60 billion as of September 30th. And in September, NVIDIA had agreed to invest as much as $100 billion into OpenAI, and that was to help the company build out the data centers, to fund all that data center build out. OpenAI, in turn, committed to filling those data centers with NVIDIA chips, right? And then OpenAI also committed to a similar deal with AMD. And then earlier, I think in October, Oracle announced that it had struck a deal with OpenAI for $300 billion of data center build. And guess which chips are going into those data centers? You guessed it, NVIDIA's GPUs. So this is not just an issue with OpenAI and NVIDIA, but there are also additional, players in here that I'm not going to mention, go through all the issues. But there's also been an increase in overall private credit financing. These are all the issues that really have investors on edge. And a lot of this is because some of this circular financing can create the illusion of growth. Is it really growing if we're just sort of passing cash from one entity to another? And it risks some sort of house of cards type of issue. And we've seen some of this before as the internet built out back in the early 2000s. So that has led, if you go to the next page, a lot of headlines just fueling the AI bubble debate. And this has been really concentrated on the overall cross-selling that I mentioned before in the previous slides. But not every AI firm is facing this issue. As I mentioned, some of these larger names like Microsoft and Alphabet, they have really solid balance sheets, and they've been funding a lot of this spend through their own cash flows. But now that there's additional money flowing in, and the spend is still outpacing the overall monetization of AI, we still aren't sure who the true beneficiaries are. Similar to when the internet was built out, we all knew every company on the planet was going to have a web page, but the true sort of beneficiary of the internet was Google in terms of search monetization. And so we still haven't figured out who the winner is going to be when it comes to AI monetization. And that's just why there's so much spend being thrown out for this, because everybody wants to be the one to win on that monetization aspect. So with that, I'll throw it back to you, Gary.
Thanks, Aya. Great comments around the circularity concerns. I know many of us look at the kind of cycle that we're in and just question about how much of it is real, right? But I think the one question that we are pretty certain of is that AI is certainly fueling growth. And if we take a look at GDP in 2025, There is no exact way to measure this, unfortunately. There's a lot of different methods of backing into exactly how much of GDP is driven specifically by AI capex or AI in general. I've seen estimates that put it around 0.5% of GDP for the first half of the year. I've seen as high as 2%. Our math and estimates that we made put us around 1.2, 1.3 percentage points in terms of the impact to GDP from AI related capital expenditures, which is a huge number. If you think back to where we were at the start of the year, we certainly had a lot of concerns about the broader economy. People believed that the tariff situation was possibly going to drive us into a recession. That clearly did not happen, but we're just seeing this huge tailwind fueled by AI that's just been largely contributed by the massive amounts of investments, both publicly and privately, into building out these data centers and all the other associated spends related with this massive build out for generative AI and other AI capacity. And so we have some numbers up here, which I think is really interesting and enticing when you take a look at the sheer numbers and the amount of growth that we're experiencing. And so in 2024, global corporate AI investment hit 252 billion. We note that generative AI alone was 34 billion. This is definitely a US story more so than any other country. Last I saw that in US, the US's share of that 252 billion was over 110 billion, which was nearly 12 times as much as China and 24 times as much as the UK. So the US is definitely investing more money than anyone else in this area. And we should just note that it's also a public thing. We have another bullet here about AWS's GovCloud expansion in 2026, which is likely to drive a whole new wave of spending in government and regulated sectors, which are areas that tend to be a lot stickier and more consistent in terms of the source of demand. So we can expect that to continue from an infrastructure standpoint. And so we just believe that AI is just continuing to function as a genuine growth engine. This is very similar to what we saw many years ago when we saw the build out of broadband, or even going further back, the build out of the interstate system. And so this is all very important for investors because the economic impact is very real. It's likely durable. And as noted earlier, the market may already be pricing in a lot of that future growth, but it does make those entry points a little more challenging. And again, we just, not to sound redundant, but this is why we stress that diversifying and not trying to get into one part of the industry at any given time is super important. And I'm going to hand it back to Aya to talk a little bit more about some of the CapEx.
So, we wanted to put this spend in context relative to other large infrastructure projects of the past. And so when you look at the previous infrastructure projects, they typically range somewhere between 0.5% to a little over 1% in terms of GDP. And that's at the peak, right? And Gary mentioned that in 2024, there was over $250 billion of spend. And I will tell you that just in the third quarter of 2025, between Amazon, Meta, Microsoft, Google, and Oracle, they had a combined spend of over $106 billion in CapEx. And that's just in one quarter, right? And this equates to another, about 1.4% of overall GDP. And so you can see that the growth and the impact to the overall economy is actually fairly large. And it goes to some of the narratives that we've been hearing about the overall economy, and that economy seems to be doing really great, but consumers aren't really feeling it. And I will tell you that a lot of this has to do with the fact that the CapEx spending, the spending that's happening from these tech companies, it's not as great of an economic multiplier as other capital spending typically is. So when you look back in history, some of the sort of bigger CapEx spends or infrastructure projects have greater impact on the overall economy because when you put in a new factory, it tends to create new jobs, right? At least in the past. But tech investments, such as those data centers, they don't come with a lot of jobs associated with them, right? They're sort of automated. There's servers, there's cooling systems. There's a lot of equipment in there and a lot less labor. And so, Wells Fargo in one of their notes said that, the 1%, each 1% of growth in technology, processing, and equipment growth into the economy only translates to 0.09% job growth. It's only 0.19% in non-tech investments. However, when you look at it, it's about half, right? And so it really is not much of an economic multiplier from a labor standpoint. And that's what's a little worrisome, at least from a consumer standpoint. So typically we would love to look at this CapEx spend as a positive for the overall economy, and it is. But the labor associated with it is a lot smaller than it typically is in other infrastructure projects. And with that, I'll hand it back to you, Gary.
Thanks, Aya. I think we're going to shift a little more towards labor and corporate strategy at this point, because this has really been fascinating, and many of us are seeing this in our day-to-day jobs, right? AI is clearly redefining what it means to be productive, particularly in white-collar jobs. And so, tasks that used to take hours, everything from analysis, reporting, content creation, research, most of which can be done in minutes with these tools. And instead of replacing entire jobs, the early evidence shows that AI is reshaping tasks within roles. So workflows are compressed, capacity increases, and what this means is that companies can produce more with the same number of people. That typically boosts margins. And of course, margin expansion is one of the most important drivers of earnings growth. So the next point really to call out here is that early adopters are gaining a measurable advantage. And we're seeing a clear divide between companies that are leaning aggressively into AI and those that are moving more cautiously. And so for early adopters, AI is helping reduce operational bottlenecks, speed up decision-making, improve customer experience, strengthen forecasting, and CFOs now view AI as a core strategic lever. And this definitely matters because as AI adoption is becoming a competitive differentiator, we note that companies that are deploying AI effectively can and will widen the gap between themselves and more slower-moving peers. At the same time, this brings organizational challenges, right? So AI adoption is also going to bring on challenges related to data governance and security, regulation, skill development, and ethics. So leaders have to rethink how teams are structured, what skills will be needed to develop, and how to balance automation with human expertise. So if you put this all together, this simply means that labor markets are going to evolve, but not collapse. So we're not seeing kind of the disappearing of jobs at this point. It just means that job compositions are evolving. And so we're seeing new roles coming in AI and operations and oversight, prompt design, data engineering, as well as compliance. And so for investors, AI's impact on the workforce and corporate strategy has really three different implications. Margin expansion as productivity gains translate into earnings growth. Capital allocation, as companies invest wisely in AI, they can build out a competitive advantage. And lastly, from a sector perspective, industries with higher automation or heavy data needs have the ability to outperform, while slower adopters could risk being left behind. Aya?
Thanks, Gary. So, we are seeing this when we listen to companies on their earnings call. So the chart over to the left shows that a lot of companies are continuing to talk about AI on their earnings call and talking about it in that productivity context. And then the chart over to the right really shows it by sector. And according to a McKinsey study that talks about the state of AI in 2025, their survey stated that most companies are still in that experimentation or piloting phase of really incorporating AI. About 2/3 of the respondents said that they haven't begun fully scaling across the full enterprise. A lot of this is because, despite the benefits of automation that we're talking about, we really need to sort of recategorize and rework some of the workflows in order to identify exactly where we can insert AI, especially the agentic AI, where we can have an agent create and automate and finish those tasks for us. And a lot of that tends to be some of the mundane tasks that perhaps may have been outsourced already in the past, but perhaps you can sort of insource them back in and get them done through technology. So a lot of that needs to get evaluated. Again, as Gary mentioned, security needs to be considered. And so there's a lot of aspects around it that still need to be worked out. That being said, according to Challenger data, about 16% of job cuts have been attributed to AI over the last 3 months. So it's a big issue simply because labor in general, it's the biggest cost for companies. It's about 36% of overall operating expenses across the U.S. equity market. And so it is something that, again, corporations are there to make money and make profits. And so it is an area that is going to continue to be scrutinized as we go forward. And there's going to be this debate about how much is productivity versus job displacement, and how much, where are we going to see the automation when it comes to incorporating AI into the workflows. This was another chart that came from Goldman Sachs, and that it really shows that while a minority of the layoffs discussed during the third quarter were attributed to AI, the gray line in that middle really shows that AI-related share has notably increased and reached over that 15%. I mentioned it was around 16% in the previous deck. That dark blue line is the tech-related jobs that have been impacted by AI. And a lot of this has to do with, just the automation, especially software engineers. I'm sure many of you have heard about how AI can now write a lot of the mundane portions of code and have really created a lot of productivity for many software engineers and really shortened the amount of time that it takes for them to write code. And that's been an area that's really created a lot of displacement in technology, more so than in other areas of the workforce. So, AI adoption overall by firms now stands around 17%, according to the Census Bureau's business trends, and a significant increase. It's been a significant increase from the 10% sort of rate that was reported just a few months ago in September of 2025. So we're seeing massive adoption. The rates are really large, but it's still sort of right now, at least, still within more tech companies than it is non-tech companies. And with that, I will hand it back to you, Gary.
Thanks for that. So I'm going to tie things up here, just to spend a moment just recapping what we've learned so far. I think it goes without saying that markets have been pricing AI quite aggressively. We talked about how the economic impact is certainly real, but we are arguably in the very early innings. We talked about how corporate adoption is accelerating, and you're seeing more and more mentions and inclusion about AI within strategy and in corporate earnings reports, more so than ever before. And there remains a lot of risk out there, certainly around concentration of those hyperscalers in the Mag 7. Valuations are certainly elevated, and we have to, of course, pay attention to what's happening on the debt side of the balance sheet. If we jump one more slide, just to take us home here, we note that market leadership definitely remains narrow. That is probably the number one concern that we want to pay attention to. That said, AI infrastructure, chips, data centers, and cloud, they all offer real long-term growth potential, grounded in just real solid demand. And there's just so much productivity out there, and productivity enhancing companies that are using AI to do more with less, which give us the potential to see stronger margins and earnings growth over time. And so as investors, we want to emphasize that diversified portfolios with thoughtful AI exposures is the most prudent way to participate in this AI theme without over-betting on a single company or subsector. And I'd also throw out there that you probably have more AI exposure than you think, simply by owning even just the S&P 500 index, which is itself so concentrated that you don't need to go all in on AI or avoid it entirely. I think the takeaway is to embrace this. It is a powerful long-term theme, but always with everything, anything that's thematic and when it comes to investing, do it within the framework of diversification, risk management, and of course, your own personal financial plan. And with that, I know we're coming up on time here, but we might have a few minutes for a couple questions. So, Tom?
Yeah, I want to be sensitive to everyone's time, so I think we're only going to do a couple questions here. The first one, with so many new and emerging AI companies out there, how can I know which ones are worth investing in?
Aya, do you want to take that?
Sure, I'll take that. Yeah, that's a great question. Again, when you're evaluating any company, you really have to do a little bit of homework and figure out whether or not the growth rates that are out there are truly achievable or not. And then what price are you paying, right? And I think another difficult portion of this is that a lot of the companies that are purely focused on AI, the companies such as OpenAI for ChatGPT, Anthropic, Claude, a lot of these companies are still private, right? So we don't have that transparency that we normally would, or that we have in perhaps previous cycles with the public companies that report quarterly earnings and all those kinds of things. And so, it's a balance because you won't get full information. And I think it's just a matter of trying to get a full picture. It's really difficult because things are changing so fast. And again, I go back to what Gary mentioned earlier, is just making sure that you have a diversified portfolio that allows you to participate in this thematic without taking that too much risk in your portfolio.
All right, last question here. It seems like AI adoption among corporations is becoming greater and more widespread. How is it impacting the labor market?
Good question. We did address that to some degree in our presentation, and I think I had also pointed out that it is becoming one of the larger reasons for layoffs, but we're not seeing any type of massive layoffs at this stage. I'll respond just by reiterating some of the things that we talked about. We're seeing a shift in the composition of a lot of jobs, and so while some jobs may become more redundant, others are being created. So a few examples: content creation, report generation, analysis. We used to hire somebody simply just to read stock reports, and now AI can do that in a matter of seconds. Yet at the same time, data governance, compliance, oversight, there's a lot of other new jobs that are being created, and just prompt engineering in of itself. And I can speak for myself. I'm sure many of you out there know as well. There's a world of opportunities out there that AI is creating, and just the amount of capabilities and things that we can do. We're so early in this that we're discovering new ways that we can leverage it. We just haven't seen a meaningful reason to decrease the labor force at this stage. Of course, things can and could change, but I think it's going to be interesting to see how this evolves. More so of a shift in composition of the workforce in terms of a major reduction. But certainly, as this evolves, we will follow up with more insights as they become more visible.
All right, thanks for that. And again, that's going to be all the time we have for questions, but anything that we did not get to, someone will reach out to you and hopefully answer that for you individually. I want to thank Gary and Aya again for joining us, and I want to thank everyone out there for also participating in this. And if you've got any further questions about AI, anything investment market related whatsoever, even anything financial planning related, like estate planning, insurance, feel free to reach out to an advisor. We've got people all over the country who can help you out with anything that you might need. And I would just leave you with, this is not something that you would want to wait on. If you've got any questions, reach out today. Thanks again for joining us, and everybody have a safe and happy holiday.
Thank you.
Thank you.